The most dangerous moment for a man's wealth isn't when the market is screaming. It's when the market is lying, and only a few people have the tools to spot the deception. Right now, on the other side of the planet, a mathematical fracture has appeared. While you were focused on the holidays, the Shanghai Futures Exchange just priced physical silver at over $80 an ounce. At the same moment, the ticker on your phone in the United States is telling you it's worth $71, a $9 gap. In the world of institutional finance, we don't call that a difference in price. We call it a structural failure. If you are 40, looking at your 401k and trying to calculate how much time you have left before you can finally step away from the grind, this $9 gap is the only number that matters. It is a signal that the pricing mechanism you have trusted your entire life, the one that tells you what your labor, your time, and your savings are worth, has officially snapped. This has happened before. 1968, 1980, 2011. History doesn't care about your holiday plans. It doesn't care about the soft landing narrative being sold on cable news. History only cares about patterns. And the pattern we are seeing right now is one of a physical world finally divorcing itself from a paper one. When a $9 premium explodes in a market as liquid as silver, it's a warning shot. It's the sound of the engine seizing because the oil has run dry. You're being told that the silver in New York doesn't actually exist at the price they are quoting you. Because if it did, the smartest money in the world would be buying it here and flying it there for an instant, risk-free profit. But they aren't. They can't. The bridge is out. The vaults are hollow. And if you don't understand the logic of this decoupling, you're walking into the most volatile period of your financial life with a blindfold on. Most men will dismiss this as a glitch. They will wait for the experts to explain it. But by the time the explanation hits the mainstream, the opportunity to protect what you've built will have vanished. History shows us that when the physical price and the paper price diverge this violently, the paper price doesn't just catch up, it collapses upward. We are entering a phase where the discount window for real assets is closing in real time. This isn't about speculation. This is about the fundamental physics of supply and demand reclaiming its throne from the digital magicians of Wall Street. If you think $80 is the ceiling, you're still looking at the old map. $80 is the new floor. And the reason why is hidden in a mechanism that most people have forgotten how to read. For the past 30 years, the financial reality you've lived in has been governed by a single comfortable illusion, that a digital entry on a screen is equivalent to the physical substance it represents. This is the era of the paper claim. Whether it's your brokerage account, your pension fund, or the silver contracts traded in New York, you are holding a promise, not a property. The $9 gap between Shanghai and New York is the first visible crack in this illusion. To understand why this matters to your family's future, you have to understand how the magicians on Wall Street have kept the price of real assets suppressed for decades. They use a mechanism called rehypothecation. It is a complex word for a very simple and very old trick, selling the same bar of silver to 100 different people at the same time. In a normal world, if you own something, no one else can own it. But in the world of paper silver, the banks trade hundreds of ounces of digital silver for every 1 ounce of physical metal sitting in a vault. As long as no one asks for their metal, the game continues. The banks can flood the market with paper silver whenever the price starts to rise, artificially increasing the supply and keeping the price suppressed. This is why, for years, you've seen silver struggle to stay above $30 while everything else, your groceries, your home insurance, your truck, has doubled in price. But there is a fatal flaw in this algorithm. It requires the physical metal to stay in the West. The $80 price in China is the sound of the East calling the bluff. China is no longer interested in trading paper promises for paper dollars. They are using their massive industrial engine to demand the physical reality. When the Shanghai Futures Exchange prices silver at a $9 premium, they are effectively turning on a giant vacuum cleaner. They are telling every bullion bank, every refinery, and every institutional holder, we don't care about your digital contracts. We want the bars, and we will pay more than anyone else to get them. This is where the illusion breaks. This is what we call arbitrage failure. In a healthy market, the $9 spread should be closed in minutes. A bank should buy silver at $71 in New York and sell it at $80 in Shanghai. But they aren't doing it. Why? Because you cannot arbitrage a ghost. To close that gap, you need physical bars that are available for delivery. But when you look at the internal data from the Western vaults, you see a terrifying trend. The metal isn't there. It has been leased out, sold multiple times over, or is already spoken for by industrial giants like Tesla and Samsung. You are witnessing the death of the paper price. For 40 years, the world accepted the price set in New York because New York was the center of the physical world. Today, the center of the physical world is the factory floor in Shenzhen and the solar grids of the Gobi Desert. They are the ones who actually need the silver to function. They don't want a hedge, they want an ingredient. For a man in his prime earning years, the lesson is clear. The system you rely on to value your wealth is currently decoupled from the physical world. Most people are still looking at the $71 price on their apps and thinking silver is stable. They're like people looking at a thermometer that has been dipped in ice water while the house is on fire. The $80 price in Shanghai is the real temperature of the global economy. The banks are trapped in a feedback loop. They cannot lower the price in Shanghai, and they cannot raise the price in New York without triggering a massive margin call on their own short positions. So they wait. They hope that the public doesn't notice the $9 gap. They hope that you keep your money in digital promises, while they scramble behind the scenes to find enough physical metal to keep the lights on for one more week. But history is a cold judge. Whenever a paper system tries to fight a physical reality, the physical reality always wins. It happened to the Roman denarius when they kept shaving the silver content until it was just copper washed in tin. It happened to the assignats of the French Revolution. And it is happening now to the digital silver market. We are moving from an era of dark price manipulation to an era of physical scarcity. And in an era of scarcity, the only thing that matters is what you can actually hold in your hand. The $9 gap isn't a glitch, it's the exit sign. And the door is getting smaller every hour. Patterns in history are like gravity. You can ignore them for a while, you can build elaborate systems to pretend they don't exist, but eventually the weight of reality becomes too much to bear. What we are seeing with the $90 Shanghai premium isn't a modern anomaly. It is a recurring historical event that marks the end of centralized price control. To understand where we are going, we have to look back at three specific moments when the paper walls of the financial establishment crumbled because the physical vaults ran dry. First, consider the London Gold Pool of 1961-1968. This was a collective of the 8 most powerful central banks in the West. Their mission was simple: keep the price of gold at $35 an ounce to maintain the illusion of the dollar's strength. For years, they succeeded. They flooded the market with physical gold whenever the price rose, using their massive reserves to suppress reality. But in the mid-60s, a pattern emerged that looks hauntingly familiar to today's silver market. Demand from Europe and Asia began to accelerate. The paper gold market in London started to see massive withdrawals. The central banks tried to keep the $35 lid on, but by March 1968, the drain became a flood. On one Friday alone, now known as Black Friday, investors in foreign nations demanded tons of physical gold. The banks couldn't meet the demand. They didn't have enough bars to ship. The result? The London Gold Pool collapsed in a single weekend. The market was shut down, and when it reopened, the fixed price was dead. Gold began its march from $35 to $800. The lesson for a man today is this: central banks can control the price only as long as they have the physical inventory to back up their bluff. Once the inventory hits a critical low, the price doesn't just move, the system breaks. Second, let's look at a more recent fracture, the LME nickel squeeze of 2022. This is the blueprint for what is about to happen to silver. For years, the London Metal Exchange, LME, was the New York of nickel, a place where paper contracts determined global value. But in March 2022, a massive industrial player from China, Tsingshan Holding Group, held a massive short position, betting the price would stay low. Meanwhile, physical inventories were plummeting. When the market realized there wasn't enough physical nickel to settle the paper bets, the price exploded from $30,000 to over $100,000 in a matter of hours. The arbitrage didn't work because there was no metal to ship to close the gap. The LME was so terrified of a total systemic collapse that they did the unthinkable. They canceled thousands of trades and shut the market down. If you think your digital silver holdings are safe, the nickel squeeze is your warning. When the physical reality hits the paper ceiling, the exchanges will protect the banks, not you. They will change the rules mid-game. This is why the $9 gap in Shanghai is so terrifying for the institutions. It shows that the physical demand is now coming from an entity, the Chinese industrial complex, that the West cannot control or shut down. Finally, we must look at the 1971 Nixon shock. For decades, the U.S. promised that $35 could always be exchanged for an ounce of gold. This was the foundation of global trust. But as the U.S. printed more paper dollars to fund wars and social programs, the gold-to-paper ratio became dangerously skewed. Foreign nations, led by France, saw the pattern. They began to suspect that the U.S. didn't have the gold to back up the paper. They started sending ships full of paper dollars to New York and demanding the gold bars back. Just like the $80 premium in Shanghai today, the market was telling the truth while the government was telling a lie. On August 15, 1971, Nixon was forced to close the gold window. He didn't do it because he wanted to, he did it because the vaults were empty. The promise was broken because the physical was gone. Now bring these three stories to the present day. You see the same logic playing out with silver, The West has used paper contracts, COMEX, and LBMA to suppress the price for 50 years, just like the gold pool did in the 60s. But now, China is acting like France in 1971, demanding the metal instead of the paper. And the price explosion in Shanghai is mimicking the vertical move seen in the nickel market. History doesn't warn you with a loud siren. It warns you with a quiet divergence in data. A 9-gap is history as a way of whispering that the vaults are empty. Once again, for a man who has spent 20 years building a career and a family, these historical anchors aren't just trivia. They are the evidence that the system you are betting your retirement on is structurally incapable of surviving a physical bank run. The institutions will tell you that this time is different. They will tell you that modern computers and central bank interventions make these historical comparisons irrelevant. But math doesn't care about your era. If you sell 100 claims to a single bar of silver and 10 people show up to take delivery, you are bankrupt. It doesn't matter if it's 1968 or 2026. The $80 price in China is the first 10 people showing up at the window. The question is, where will you be when the other 90 realize the door is locked? The greatest mistake a Western investor can make right now is assuming that the $80 price in Shanghai is being driven by speculators. If this were a bubble, like the meme stocks or the cryptomanias we've seen, the charts would be driven by retail traders in dark rooms chasing me to the moon narrative. But that isn't what the data shows. The volume surging through the Shanghai Futures Exchange isn't coming from gambling accounts. It is coming from commercial hedging accounts. In plain English, the whale buying silver at $80 isn't a hedge fund. It is the factory floor. We are witnessing an industrial run on the bank. And for a man who understands how the real world works, how things are built, shipped, and sold, the distinction is terrifying. In a financial run, you want your cash back because you're afraid the bank will close. In an industrial run, you want your metal because if you don't get it, your factory dies, your workers go home, your multi-billion-dollar contracts for solar arrays and electric vehicles evaporate. This is why China is willing to pay a $9 premium. It's not because they are bad at trading. It's because they have hit the thrifting wall. For a decade, Western analysts told us not to worry about silver demand. They said solar panel manufacturers would thrift silver away, using less and less of the metal or replacing it with copper. That narrative is now dead. The industry has shifted to TOPCon and HJT cell technology. These high-efficiency panels require 50% to 80% more silver than the old generation. You cannot reduce the silver content any further without sacrificing the efficiency of the panel. China controls 80% of the global solar supply chain. They have done the math. They know that to meet their 2026 and 2027 energy targets, they need physical silver that simply does not exist in the current mine supply. When a CEO in Jiangsu province looks at the global inventory, he doesn't see a market price of $71. He sees a looming famine. And in a famine, you don't haggle over the price of bread. You buy every loaf on the shelf before the doors are locked. But solar is only half the story. The real black swan for silver is the solid-state battery shift. Reports are now confirming that the next generation of EV batteries, the ones that will provide 600-mile ranges and 9-minute charge times, rely on a silver carbon composite anode. A standard electric vehicle today uses about 20 to 50 grams of silver. A solid-state EV will use up to 1,000 grams. That is a 20x to 50x increase in silver consumption per car. Now, look at the geography. China is the world's largest EV maker. Companies like BYD and CATL aren't just manufacturers. They are strategic hoarders. They saw what happened to lithium in 2021 when the price went vertical. They learned their lesson. They aren't waiting for the silver to be mined in 2027. They are buying the entire float of the market right now at $80 to ensure their competitors in the West are left with nothing but paper contracts. This is why the $9 gap won't close. The silver isn't being traded, it is being consumed. Once those bars hit the loading docks in Shanghai, they are melted down into industrial paste. They are gone forever. They will never return to a COMEX vault to satisfy a Western paper claim. For the man sitting in the US, watching his retirement account, you have to realize who you are competing against. You aren't competing against a day trader in his basement. You're competing against the state-backed industrial complex of the world's largest manufacturing economy. They don't care about your Fibonacci retracements or your dollar index. They care about the survival of their industries. When a strategic buyer becomes price inelastic, the rules of the game change. They will pay 80. They will pay 100. They will pay 150. Because the cost of the silver is a fraction of the cost of the final product, but the product cannot exist without it. Silver is the oxygen of the modern technological world. And right now, the East is sucking all the oxygen out of the room. The Western vaults are being hollowed out to feed the dragon's hunger. While you're being told that inflation is cooling, the world's factories are screaming that the most vital metal on Earth is running out. The $80 price is the sound of the door slamming shut. In the world of institutional trading, there's a period we call Ghost Week. It's that thin stretch of time between Christmas and New Year's Day. For most people, it's a time for family and relaxation. But for a historical analyst, Ghost Week is the most dangerous window in the financial calendar. It is a time when the guardians of the system, the senior traders at JP Morgan, Goldman Sachs, and HSBC, are on vacation in Aspen or the Hamptons. Their desks are left in the hands of skeleton crews, junior analysts, and most importantly, automated maintenance algorithms. This creates a liquidity vacuum. On a normal Tuesday in October, there might be 5,000 contracts standing between a price of $71 and $72. During Ghost Week, there might only be 50. Now imagine what happens when a $9 price magnet from Shanghai meets this vacuum. The high-frequency trading, HFT algorithms that govern the New York markets done know it as the holidays. They only know math. And right now, their screens are flashing red with an arbitrage opportunity. The algorithm sees silver in Shanghai at $80 and silver in New York at $71. Its primary instruction is to close that gap. Normally, humans would intervene. A senior trader would see that there is no physical metal available to ship to China and would manually override the buy order to prevent a price spike. But the humans are gone. The algorithms are on autopilot. This is the setup for a super gap. As we move into the final days of the year, we are staring down the barrel of a collision of realities. On one side, you have the industrial giants in China, BYD, CATL, and the solar firms, who do not stop for Western holidays. Their factories run 24/7. They need silver for January production, and they are buying it on the Shanghai exchange at $80 because they have no choice. On the other side, you have the hollowed-out vaults of the COMEX in New York. We've seen the reports. 1.4 million ounces withdrawn from the Asahi vault in a single day. 600,000 ounces gone from JP Morgan. These are the registered ounces, the only ones available to settle a trade. The cupboard is bare. When a Chinese industrial buyer hits the buy button for 5 million ounces tomorrow morning, the order will ripple across the global network and hit the New York order book. Because the room is empty, the price won't tick up by pennies. It will skip. It will jump from $71 to $73, then to $76, searching for a seller. But who is selling? The miners are holding back supply, waiting for the higher prices they know are coming. The institutional investors are watching the Shanghai premium and moving their metal into private storage. The only people left to sell are the market makers, the banks. But here's the trap. The banks are already short. They have sold paper promises for silver they don't have. If the price gaps up to $70 during Ghost Week, their risk management software will automatically trigger a stop loss. To protect the bank from infinite losses, the computer must buy silver futures to close the position. Buying pushes the price higher. A higher price triggers more stop losses. More stop losses trigger more buying. This is a feedback loop from hell, and because it is happening in a liquidity vacuum, there's nothing to stop the price from teleporting toward the Shanghai reality of $80 in a single trading session. For the man who has spent his life playing by the rules, saving his money, paying his mortgage, trusting the system, this volatility is going to feel like a panic. The news will call it a flash crash or a glitch. They will try to tell you that the market is broken. But the market isn't breaking, it is healing. The $71 price was the lie. The $80 price is the truth. The Ghost Week gap is simply the moment when the lie can no longer be sustained by the absence of its masters. History shows us that the final phase of a price suppression scheme always ends with a vertical gap. It happened with the Swiss franc in 2015 when they unpegged from the euro. It happened with nickel in 2022. It happens whenever a central authority tries to fix a price that the physical world can no longer afford. At this stage of the cycle, things no longer move in years. They move in months, weeks, and during Ghost Week, in hours. If you are waiting for a clear signal from the media to protect your family savings, you are waiting for an invitation that will never come. The signal is the $9 gap. The signal is the empty vault at Asahi. The signal is the silence of the traders in Aspen. By the time the senior partners fly back to New York on January 2nd, the world will be different. The Western discount will be a memory. The price will have reset to a new reality, and those who are left holding paper promises will find that their claims are settled in depreciating dollars, while the real metal has already moved east. The most common question I get from men who have spent their lives building businesses or managing corporate teams is this: if this gap is so obvious, why aren't the professionals talking about it? It's a logical question. We are conditioned to believe that the smart money on Wall Street sees everything first. But history proves that institutional blindness is a recurring feature of every major financial collapse. There are 3 psychological blind spots that prevent the majority of the financial world from seeing the 80-day reality until it is too late. The first is normalcy bias. For 50 years, silver has been a boring asset. It stayed in a range. The banks manipulated the paper price, the analysts issued their reports, and the world kept turning. Most professional money managers today have never lived through a systemic physical shortage. Their models are built on the assumption that the past will always predict the future. They look at the $71 price on their Bloomberg terminals and assume that because it was $71 yesterday, it must be the correct price today. They are emotionally and intellectually incapable of processing a break in the pattern. The second blind spot is faith in the mechanism. Western traders have a religious-like faith in the arbitrage engine. They believe that if a gap exists, a computer somewhere will close it. They don't realize that the computer can only close the gap if it can move the atoms. We have moved from a digital crisis to a physical one. Most institutional analysts don't understand supply chains. They understand spreadsheets. They don't know that a refinery in London is booked for 6 weeks. They don't know that the lead time for 1,000-ounce bars has tripled. They are looking at the map, not the terrain. And as the old military saying goes, when the map and the terrain disagree, the terrain always wins. The third and most dangerous blind spot is incentivized ignorance. It is very expensive to be right about the end of a system before the system actually ends. If a junior analyst at a major bank wrote a report tomorrow saying that the COMEX is empty and silver is headed to $150, he would be fired by lunch. The banks rely on the illusion of stability to keep their clients' money in fee-generating paper products. They are incentivized to tell you that everything is fine, right up until the moment they lock the doors. This is why you feel a sense of unease that your financial advisor doesn't share. You are looking at the logic of the $9 gap while he's looking at his compliance manual. For the 35, 45-year-old man, this is the moment of personal audit. You have to realize that you are not being irrational or alarmist. You're simply observing a pattern that the institutions are paid to ignore. In 2008, the experts said subprime was contained. In 2020, they said the supply chain disruptions were transitory. In both cases, the man who trusted his own eyes and the historical patterns was the one who protected his family. The institutions are currently trapped in what we call a liquidity mirage. They see the reflection of silver on their screens, but when they reach out to grab it, their hands find only air. The $80 price in China is the first time the mirage has begun to evaporate in the heat of industrial demand. You have to decide who you trust, the analyst who is paid to keep you in the burning building, or the historical pattern that shows you exactly where the exits are. The majority will stay in the building because they are waiting for a permission slip from an authority figure to leave. But by then, the stairs will be gone. The $9 premium is the quietest, most honest warning you will ever receive. It is a signal that the authorized reality is no longer functioning. Once you see it, you cannot unsee it. You are now among the few who are awake before the alarm rings. The natural impulse for a man who has seen his assets stagnate for years is to look at a sudden jump to 80 and think, I should sell, I should take the win. This is the retail brain talking, the part of us conditioned by decades of price suppression to believe that any significant move upward is the bubble that must be popped. But if you understand the historical pattern of a structural re-rate, you realize that $80 isn't the ceiling, it is the new floor. To understand why, we have to look at the gold to silver ratio. For thousands of years, the ratio of gold to silver was approximately 15.1. In the modern era, the central banks managed to stretch that ratio to 80.1 or even 100.1 by using the paper manipulation we've discussed. This made silver the most undervalued asset on Earth relative to the money supply. When a decoupling happens, when the physical world takes over from the paper world, that ratio begins to compress violently. If gold is trading at $4,200 and the historical ratio returns to even 30.1, silver isn't an $80 asset. It's a $140 asset. At the historical 15:1 ratio, it's a $280 asset. The $80 price in Shanghai is simply the first step in this compression. It is the market's way of saying that the era of cheap silver is officially over. Think about the psychology of an industrial CEO. For 30 years, silver was an afterthought in their budget. Now it is a strategic liability. When the price hits $80 and the vaults stay empty, their behavior changes from just in time to just in case. They begin to hoard. This hoarding creates a secondary layer of demand that has nothing to do with production and everything to do with survival. They won't sell at $80. They will buy more at $90 to protect the inventory they already have. We are entering a phase called price discovery. This is a rare moment in history where an asset, Einsteins true value, is determined by the people who actually need it rather than the bankers who trade digital versions of it. In price discovery, the move is never linear. It is exponential. You have to rewire your brain. If you sell your silver at $80, what are you getting in return? You're getting dollars, a currency that the Federal Reserve has admitted must be debased to service the $35 trillion national debt. You're trading a scarce, strategic, industrial necessity for a paper promise that is losing purchasing power every single day. Selling your silver at $80 as the East is buying it at a premium is like selling your seat on a lifeboat while the ship is listing at 45 degrees because someone offered you a stack of wet napkins. The $80 floor is being built by the largest manufacturing engine in history. It is being backed by the reality of solar energy and the future of transportation. It is not a speculative spike. It is a fundamental shift in the global hierarchy of value. For the man looking to protect his family's future, the strategy is no longer about timing the market. It's about positional security. It's about being on the right side of the gap before the gap becomes a chasm. The institutions will try to shake you out. They will use the Ghost Week volatility to trigger flash crashes and red candles on your screen. They want you to panic sell your physical metal so they can use it to settle their own institutional debts. They need your ounces because they don't have their own. Don't give them the satisfaction. Understand that $80 is the signal that the old world is dead. The new world values reality over promises. It values atoms over bits. And in that world, the man who holds the metal makes the rules. The $9 gap was the invitation to the table. $80 is just the first course. History does not announce itself with trumpets and headlines. It moves in the shadows, in the quiet spaces between data points, until the momentum becomes an avalanche. For the man who has watched this analysis to the end, you now possess a piece of knowledge that 99% of your peers do not. You see the $9 gap, you understand the industrial run, you recognize the Ghost Week trap. But knowledge without a shift in perspective is just trivia. The greatest legacy you can leave for your family isn't just a 401k or a house with a mortgage. It is the ability to recognize when the rules of the world have changed. We are living through a pivot point that only happens once every few generations. It is the moment when the paper era surrenders to the physical era. Throughout this series, I have shown you patterns. The pattern of the London gold pool collapse, the pattern of the nickel squeeze, the pattern of the dragon's hunger. These are not guesses. They are the mechanics of a system reaching its thermal limit. When silver hit $80 in Shanghai, it was the sound of the fuse reaching the barrel. You don't need to be a prophet to see what happens next. You only need to be an observer of reality. In the coming weeks, you will see a lot of noise. You will see experts explaining why $80 is an anomaly. You will see volatility designed to shake your conviction. You will see a media machine desperate to keep you in the dollar-denominated dream. But remember the loading docks in Jiangsu. Remember the empty vaults at Asahi. Remember that physical metal cannot be printed, and it cannot be fixed by a central bank algorithm once it has left the building. The shift we are witnessing is silent, but it is absolute. Your task is not to panic. Panic is for those who are surprised. Your task is to prepare, to audit your own holdings, to ask yourself, how much of my wealth is a promise and how much is property? In a world of $80 silver, the answer to that question will determine the trajectory of your family's next decade. Listery doesn't warn you loudly. It repeats in silence. And for those who have ears to hear, the silence right now is deafening. We focused on silver because it is the most distorted market in history, the first domino to fall. But as this gap closes and the arbitrage breaks, it will trigger a chain reaction in another strategic asset, a metal that is even more critical to the AI revolution and even more tightly controlled by the East. Very few people are looking at that second gap yet. But the pattern is identical, and as we move into the first weeks of the new year, that is where the real story begins. For now, watch the spread, watch the delivery reports, and trust the patterns over the promises.